This module will go into more detail on the Coso framework elements. As we covered in the previous module, the Coso framework was updated in 2013. The overarching theme is that Coso has taken the next step to further define the components of internal control and expands the definition of the reporting objective. Plus, times have changed in 20 years. There's more expectations for governance oversight. There's been globalization of markets and operations, changes and increased complexity of business operations, more and more changes and additions to regulations, standards, and laws, expectations, growing expectations for competencies and accountabilities, use of technology, and overall increased expectations related to the prevention and detection of fraud. So let's dive a little bit deeper into the 17 key components. So control environment. Management may elect to view the framework components as a top-down approach to control environment design. At the highest level is the control environment, which is often thought of as the tone at the top. And this encompasses the organization's management and the board's attitude towards the concept of internal control. This component ensures and demonstrates that management and the board value internal control and have set organizational goals to ensure that a high morale and ethical standard is upheld by both executive management and the employees and is reflected within their behavior. For example, management may demonstrate commitment to integrity and ethical values by establishing an organizational code of conduct, which executives and staff must read and acknowledge via signature on an annual basis. The board of directors may demonstrate independence of management and exercise oversight for the development and performance of internal control via the formation of an internal audit committee of the board of directors, which regularly reviews findings, recommendations, and results of an internal audit function. Overall, control environment encompasses having the right individuals involved in running the organizations with strong values. This is one diagram depicting the control environment as it relates to financial reporting. As you can see, the control environment serves as an umbrella for the entity's internal control framework. Good internal controls will not be effective without a sound control environment. Or another way to look at it is, a really good control environment is the foundation for strong internal controls. If you could truly create a culture where no theft occurred, would you even need to lock the doors? The board and senior management are in charge of setting the stage for an entity-wide control environment. However, departmental managers should establish departmental policies as necessary in light of their unique objectives and risk factors in the absence of any central policies. Listed here are some specific areas that the control environment should cover. Key controls should cover hiring practices, training programs, whistleblower policies, code of ethics, and clear lines of responsibility and authority. In addition, as part of your regular business processes, you should continually monitor and update your control environment for dynamic changes. Another thing to keep in mind when designing or reviewing your control environment is the difference between compliance and integrity strategies. A compliance strategy tries to prevent violations of regulations and self-interested behavior by employees by imposing standards of conduct that are intended to compel acceptable behavior. A compliance strategy relies more on lawyers and compliance officers. An integrity strategy seeks to create conditions that support right action by communicating the values and vision of the organization, aligning the standards of the employees with those of the organization, and relying on the whole management team, not just the lawyers and compliance officers. Overall, a compliance strategy focuses more on preventing wrong, while an integrity strategy focuses more on fostering right. Sometimes a combination of both may be warranted. Finally, in order for the control environment to be effective, it must be documented. The first step in ensuring proper internal controls is to ensure business processes are properly identified and documented. The types of documentation that can be useful would include process narratives, organizational charts, flow charts, questionnaires, memos, and checklists. The second component of the internal control framework is risk assessment, which involves a dynamic process for identifying and assessing risks. The risk assessment component provides guidance to ensure that management engages in activities to identify, evaluate, and mitigate risks, including those arising specifically from fraud. A risk is the possibility that an event will occur and adversely affect the achievement of objectives. Risks can be introduced by changes, for instance, new leaders and managers, new markets and products, growth, and emerging technologies. One way to categorize risk is along 4 key risk areas: strategic, financial, compliance, and operational. Strategic risk includes political risk, talent and succession planning risk, and risk from dependencies on other organizations like the state or federal government. Financial risk includes the risk of audit findings and other things that would undermine reporting integrity. Compliance risk includes fraud and other non-compliance with employment practices. And operational includes the risk that programs fail to meet their objectives or other unforeseen natural disasters or lack of technology availability. The Board of Trustees and senior management must establish objectives linked at different levels of the entity, as we've already discussed, and then determine the risks to those objectives. By taking a holistic view of the organization's objectives, management should then be able to apply internal control to achieve multiple objectives and prevent domino effects, for example, a weakness in the financial reporting that jeopardizes ongoing operations or grant compliance. Risk assessment is especially important when resources are constrained, since risk assessment allows for more strategic use of resources. Another item to note is the difference between risk management and risk assessment. Risk management is a process applied in a strategic setting and across the entity designed to identify and manage risks to stay within a risk appetite or tolerance level to provide reasonable assurance about achieving entity goals and objectives. Risk assessment, on the other hand, is an element of internal control within the risk management process that enables management to identify and assess key risks to achieving its objectives. This assessment forms the basis on which control activities are determined. Risk assessment should occur at the business process level, or the grant level in this case, as well as the entity-wide level. Once you have identified your objectives, apply the 4 risk assessment factors: the materiality or significance of the amounts in question, the complexity of the process, history of accounting adjustments, and the propensity for change in the processes or controls. This should help you assess risk for the process in question in terms of likelihood and impact. You should also take into consideration the following internal items to assess risk: the use of qualitative, quantitative methods, change in management responsibilities, weak or unresponsive tone at the top, human capital, the quality of personnel hired and retained, the risk of employee sabotage, system security weaknesses, rapid growth, and changes in processes or access to assets. Other external considerations would be technology and advancements, changing and evolving needs or expectations of your customers or students, the changing legislative requirements and new state and federal laws and regulations, decentralized organization operations, natural disasters, and the impact of program, political, and economic changes. The third component of the internal control framework is control activities, which are the actions established through policies and procedures to help ensure management's directives to mitigate risks are carried out. These activities are performed at all levels of the entity. There are certain types of control activities, including preventative, detective, and corrective, compensating, and manual and automated controls. We will go over the difference between these control types. Control activities are exactly what they sound like, the activity part of the internal control framework. While the control environment and risk assessment set the stage for good controls, the control activities are where the meat of the control work is done. Examples of control activities include approvals and authorizations, embedded verifications, reconciliations, independent reviews, asset security, and of course our favorite, segregation of duties. The first way we can categorize control activities is between preventative and detective controls. Preventative controls does just that. It prevents the occurrence of a negative event in a proactive manner. Examples at an institution may include approval set at a certain dollar threshold for transactions of purchases, passwords for those systems and financial general ledger, petty cash and the reconciliation around the lockbox, security and surveillance systems in high-risk areas, and pre-numbered checks. Detective controls detect the occurrence of a negative event after the fact and in a reactive manner. Examples might include the review and approval by the supervisor, running reports of user activity, reconciliations, annual inventory counts, and review of missing and voided checks. Preventative controls are stronger than detective controls. It is more effective and less costly to prevent something from happening rather than to attack it on the back end. Sometimes it's hard to stop something that is already in motion. This chart also shows corrective controls, but I would really deem those as more corrective actions since the correction isn't really a control itself. There are also compensating controls which may be relied upon to mitigate existing risks if a control activity that should otherwise be in place is not in place. Compensating controls can be either preventative or detective. One common scenario is when a department or unit does not have the staff resources to establish an adequate segregation of duties. Potential compensating controls could include automation of certain transaction data that then cannot be altered by the staff, thus removing humans from the process altogether. Manager review of detailed summary reports of transactions initiated by staff. So if one staff member is a requester and her supervisor is the approver, then the overall manager of that area should, on a periodic basis, perhaps monthly, separately review summary reports of these transactions. Another option would be for a peer staff or manager, someone separate from the personnel involved with making the transaction, to select a sample of transactions and vouch back to supporting documentation. In all these ways, we are compensating for the fact that the advisable control activity or segregation of duties is not possible with current resources. The final category of controls that we'll cover are manual versus automated controls. Manual controls require action to be taken by employees. Examples include obtaining the supervisor's approval for overtime, reconciling bank accounts, or matching receipts to purchase orders. Automated controls are built into the network infrastructure and software applications, and those examples include passwords, data entry validation checks, and batch controls. Automated controls are more reliable and cost-effective than manual controls. The Information and Communication Framework component ensures that management effectively communicates the expectations related to control activities via relevant quality information distributed through proven and reliable channels. Even with so many ways to communicate these days, as our picture depicts here, sometimes it is difficult to find ways to communicate effectively and with impact. Just keep in mind that when you are trying to communicate, and keep in mind who you're communicating with. Remember that more communication is not always better, but more well thought out, directed communication is essential to all operations, including internal controls. And finally, monitoring activities, the fifth component. The Monitoring Activities Framework component ensures that the organization takes the appropriate actions to monitor the design and effectiveness of control activities and takes the appropriate corrective actions when needed. And this concludes the Coso Module 3.